Hey folks, David Frost, my strategic forecaster, here for another episode of Common Sense Market Analysis. Today is Friday, August 28, 2015. What a week it was. So we finished the week up with a quiet Friday with not much activity. The volume was considerably lighter than the volume all week long. And I was on about 155 million shares in the SPDR, and you can see here the declining volume all week long. And that's not untypical for a Friday to have lighter volume and to have a narrower trading range than the rest of the week, although even though today didn't have that much of a narrow trading range, it was still pretty narrow as compared to the rest of the week. So, what do we have going forward? Well, we have some conflicting data, and I'm going to go through some things tonight, one or two of which I don't normally discuss, but I'm going to do it anyway, and it's just going to give you a little insight into how I determine, when I tell you that there are, a short-term cycle or a longer-term cycle, I'm going to show you a couple of the things that I look at, and whether or not they play out, you really don't know till after the fact. But it's one of those things where it's just another tool in my toolbox. I use each individual tool together with all the other tools to kind of put together the so-called detective story and the pieces to the puzzle and how I make my market calls. So I'm going to show you one of those tonight that I'm looking at in terms of cycles. But let's take a look at the SPDR, and then we'll get into that in a couple of minutes. So basically, today we traded almost up into the 200 area. I think we came up just short today. We hit a high of 199.84, so we came up slightly short. We retested the prior resistance line, which was 198.07, and then traded in between that range all day long. So you can see how these levels are important. Prior resistance becomes support, prior support becomes resistance. That's the way it works, and that's what we're seeing here. So what do I think going forward? Well, I think there's a couple of scenarios. Scenario number one, and which will be supported if the cycle plays out, that I'm going to show you in a couple of minutes, but scenario number one is we pretty much, within the next day or so, pretty much, turn down here and begin the next leg down in this market. Now, I'm not sure that that's the likely scenario going forward. And I'm going to show you why first before I show you the cycles. One of the reasons is, and I'm going to go right over to the IWM tonight, and I'm going to show you the daily chart first of the IWM, and you can see that we pop back over the resistance line. Now, that in and of itself is not an extremely important development, although it is of note, and we have to respect that factor, if you will. If you look at the intraday chart, okay, let's look at the 60-minute chart real quick, and what you'll see here is that the IWM was pretty strong all day long. The IWM finished up 1.12%, $1.28. And why I think that's significant is because the SPDR, okay, was basically flat all day long, okay? It wasn't flat all day long, but it finished flat, okay? So the fact that the IWM finished up 1%, which is a pretty healthy day, and the SPDR finished flat, leads me to believe that there's a little more to this story that needs to unfold in terms of the upside, okay? And, I do this, and here's one of those patterns that I draw out for you time and time again, and this is on the hourly chart, okay? And this is a bullish pattern, right? Up move, sideways consolidation, potential another up move, okay? Now, that's not out of the question in the IWM, but rest assured, the IWM is not going to make an up move like this without the rest of the market going with it. And why is the IWM important? And this is for the newer folks. The IWM is representative of small business across America. It's the Russell 2000. It's the 2,000 small and medium businesses, okay, that are representative of Main Street America. This is where the risk assets come out first, and it's where they go in first. So it's a leader on the upside and a leader on the downside. And what I mean by that is, let's go back to the daily chart. Okay, and as you can see, the IWM was leading the market down before the S&P and Dow broke. The IWM was the weaker index. It was melting away, and basically it was telling us, it was a smoke signal telling us that there was trouble ahead. Okay, and when the IWM leads on the upside, it's the opposite effect. It's 180 degrees different in the other direction. It's telling you that there's risk assets, or there's cash going into this index, which tells you that assets are going into the riskier asset class, and that would apply to both the IWM and the NASDAQ Composite Index. Now, the NASDAQ was only up 0.33% today, but yet it was still up in comparison to the SPDR, which was flat. The Dow Jones Transports were up 0.5%, and the Dow was basically flat. So there's your conflicting data, right? There's not much we can take out of that except to just understand what each of these asset classes represent, and that we have to be aware and cognizant of the fact that there's a divergence going on. Now, the divergence will basically come together, and it will become unconverged. And I probably just made that word up, but nevertheless, they will come to in the same direction. I'm a little tongue-tied there. They will get unconverged. I'm using that word again. Okay, so those markets will link back up. Now, let me go back to the SPDR and show you the two scenarios that I think are the likely scenarios. Okay, let me move this chart over a little bit, and I'm going to show you what I'm talking about. All right, so first I showed you that there's a possibility that this could be the top, okay, right here, and we could start down, okay, beginning next week, and then I'm going to show you that there are cycles that support that story. Okay, I'm going to show you that in a couple of minutes. Okay, but the other scenario is that we do one of these, okay, and I'm going to show you where this comes from in a second. All right. And then we top out all the way up here, all right? Now, what would this represent? This would represent an A. Okay, so let's say this would be A, B, all right, and then C, all right? And you've seen me do this many times. Markets like to move, especially in corrective patterns, in A, B, C movements. So we could possibly go down next week, yet be faked out with one more move higher. And now let me show you the cycles, and this is where I'm going to diverge a little bit from what we normally talk about, but I think it's interesting, and some of you will find it interesting nonetheless, and we'll see if it plays out this way. So first, let me show you some of the representations that I found, okay? Now, February 2nd of 2015 represented what I think is a relatively important low, and if you add a Fibonacci 144 trading days to that date, you come out with yesterday's date, August 27th. And 144 in the world of Fibonacci is a very important number, okay? There are many important Fibonacci numbers, but 144 is certainly an important number. You can go look up Fibonacci on your own, read a little bit about it. It's really fascinating work, and it's what I use each and every day, and I show you the Fibonacci retracements, but there are other components to the whole Fibonacci number sequence, and they are fascinating, and they are prevalent throughout our lives, not just the market, but all throughout our lives. Okay, the second one is a February 5th low in 2010. Now, if we add 1,015 calendar days, we come out with November 16th, 2012. I'm going to show you this in a second. Now, there's not a lot of significance to the 1,015 calendar days, but I'll show you why it's significant in a minute. And then from the November 2012, November 16, 2012, if you add another same number, 1,015 calendar days, you come out with today. And the reason why this is important is cycles work in simplistic terms like this. Okay, these are cycles. Okay, there's a business cycle, there's life cycles, there's all kinds of cycles. Everything goes in cycles. So here's a low, here's a high. Here's a low, here's a high, here's another low, high, a low, high. Now, cycles go from low to high, high to low, low to high, and so on, okay? That's how the market works. That's how our lives work. Now, let me show you something. The February 5th, it's actually February 2nd, 2010, okay? Let me get rid of this. Okay. So here is February 2nd, 2010. All right. That was an important low, which marked the beginning of another rally. Okay. Now, if you take that day, okay, and you go to the, let me see, bear with me. Now, if you go to the November 16th date, which is 1,015 days, okay, this is November 16th, which was another important low. So that was a cycle that went from low, it hit a high, but then went back to another low, okay? So if you go here, let me just re-show you this, okay? Oh, I got rid of that. So let me just show you this. So the cycle goes like this, right? Here's a cycle, all right? And it goes on and on. So it went from low all the way to low, okay? And if I'm confusing you, I apologize, but it'll clear up in a second. So here is the November low, which marked 1,015 days. Now, if you take this low here, this low from November of 2000 what was it? 12, pardon me, November 16th, 2012, and add 1,015 days, where do you come? You come to, let me get rid of these, okay? You come to yesterday, okay? So that's why we could be seeing an important top, if not some kind of top, because if that cycle pans out, and cycles don't have to go from low to low to low, it's turning points. So they go from low to high to low to high. So two lows sometimes will mark a high, two highs will sometimes mark a low. There's no rule of thumb. It's really an art form. Okay, so I'm just pointing out to you that when I found the cycle of 1,015 days, and then I found another cycle or another Fibonacci number of a Fibonacci 144 trading days from a low earlier this year in February, I started to take notice and say, well, maybe the end of this week marks an important turning point. And if you remember last night, I told you that, yesterday, today, maybe into Monday may mark a cycle turn. Now, it doesn't have to, but it's something that I'm watching just in case. Now, couple that together with, okay, the potential ABC pattern, right? A, B, C. Now, it doesn't have to be an ABC, but it could be. Either way, yesterday, today, maybe into Monday, may mark some kind of a top. It may be a corrective pattern retracing a part of this up move and readying for another up move higher, or it may be the ultimate top again. We'll see. We don't know it until we see it, but I'm just giving you some insight into some of the tools that I use to determine, at least from a cycle perspective, along with a lot of other things, okay? These retracements here, these important calculations, the 200 area, the 201.63, and I put another line in here, which is this gap fill here, which is all the way up at basically, we'll call it 204, and that may mark the end. So, for example, the reason I brought that out is, what happens if this is an ABC correction? All right, that may mark the end of the final top here to fill this secondary gap. So there's a lot of things at play, and I just want you to be cognizant of all the things, or at least many of the things that I'm looking at. And if we see the market pull back next week, I'll have an idea of where that pullback may come to. And if it doesn't come to a pullback, if it continues lower, then I'll know where the market is confirming that we're readying or we're in the midst of another move lower that would be lower than the lows from Monday. So there'll be plenty of meat on the bone to be short, but I just don't want people to get faked out, and I want you to be aware that it could be another corrective pattern. Anything goes, and here's another reason why. Next week is the week before the Labor Day holiday weekend. Historically speaking, that week tends to be a bullish week. So there's a seasonality trend that becomes prevalent next week. And if that's the case, then we could see maybe just a short pullback and then another move higher that completes the following week after the Labor Day holiday weekend, maybe all the way even up here. It doesn't have to be up here. I'm just saying on the outside it could be up here. And then we would see another move down. So what I'm saying is there's divergences here, and that's why I showed you the IWM. There's a lot of conflicting data, and we have to wait for the market to really tell us what to do. At this point in time, I can't tell you that today marks a top and we're going to see lower prices, lower than the low from Monday from this point forward. I'm not ready to do that yet. There's too much conflicting data, and I don't want you to get faked out. I'm trying to give you the whole picture, and believe me, I recognize it can be confusing, but the market is designed to confuse as many people as possible before it makes the final move in which it's going to make. So I apologize if I've confused you, but yet I'm trying to give you all the necessary data to make rational decisions, and that's the reason I showed you all that stuff tonight, okay? So let's move on to the gold market. I have you see this junk in here. That's a Fibonacci retracement. So let me take that out for a second, and we'll talk. You know what? Now I'll leave it in. I'll take it out. We'll talk about the daily chart. So let's recap what I told you over the last few days. There was a high probability that this was going to be nothing other than a retracement rally, a retracement decline of a bigger rally, readying for higher prices coming, okay? And I showed you that this was the breakdown point. We rallied up, we stalled out at the prior breakdown point, and then we retraced into the breakout point where all this chart congestion is here, and I thought that that was a very, very probable and good area for the next bounce higher to begin, okay? Now, let's go to the shorter, and that turned out to be true so far. Let's go to the shorter time frame. I'm going to go to a 10-minute chart and show you what happened today. Okay, here's that low. Okay, so if I do a Fibonacci retracement and I take this low here, okay, this low, sorry folks, this low here to this high here, okay, what did we do? All we did today, and this is just a 10-minute chart. Remember, this is just the intraday move, okay? From yesterday's low to today's high, okay? All we did was retrace 0.618% of that move from low to high, okay? And now, what are we doing? We're making a potential bullish pattern here, okay? Maybe for another move higher. Now let's look at the hourly chart for a second. Let me go over to the hourly chart and I'll show you this. Now how many times have you seen me? You know exactly what I'm going to do, right? Folks that have been around a while see this coming. Move higher, consolidation, what? Readying for another move higher. Okay? Now, how do we know, or where would we know that this move could fail? Let's go back to the daily chart. Well, if we came below the $1,112 area in gold, I would have to reevaluate and see what the new calculations would provide and where we go from there. It doesn't mean we're going to make new lows. It just means that the retracement rally was going to be a deeper retracement, and this is nothing more than just a short-term bounce. But I don't think that's the case. I think there's more upside to be had in gold. And in fact, I'm going to take this 1144 off because I don't think it's valid anymore in terms of my calculations. So I'm going to leave the 1157 in, where we may find another resistance point. But I think there's more upside to be had. I'm expecting some more up days of movement in the gold market. Okay, so far this low held, and I think it's going to hold for a while. But let's see how Monday trades out, and I'll be back to you Monday night on an assessment and what we find there. So far, so good. So far, we were right in that this was a retracement rally and that we should find a low. So I feel good about that. All right, let's go over to the oil market. What happened here? We came right into the $46 area. I think we came up just short of that. The high today was $45.90. That's close enough. I think that this should provide formidable resistance for the crude oil futures contract. Now, there's a wild card. We could see another up day. There's a hurricane brewing. When hurricanes brew, it tends to spike the price of oil. And I don't know if that's the reason or not. It doesn't really matter. I just think that this 46 area is going to be somewhat of heavy resistance. And let me just see my notes here if I had. Yeah, I just think that from a short-term perspective, I would anticipate this level being pretty formidable resistance, and I would expect a pullback. Okay, but there's always a but. Well, I told you last night, don't buy oil because we have to wait for pattern, and then of course we rocketed up today. So there just wasn't anything telling me higher prices were coming. What we're looking for now is we're looking for a pattern development. I'm going to tell you the same thing I told you last night. If we see something like this develop, okay, 3 to 5, 6 days of sideways movement, then we're in business. Then we could see the makings of a bullish pattern to continue. So also I can do it another way for you. I can say that there's a possibility that this could be an A, B, C corrective pattern, maybe taking us high as $49, $50 into the 50-period moving average. We'll have to see where that 50-period moving average would be at the time. But same thing, that ABC pattern could be developing. So let's say that we saw a pullback for a few days next week. Okay, pullback, okay, and then move higher. So that would be A, B, C. So there's a lot of possibilities for the crude oil contract, and we'll keep you in the loop next week, but I just don't think that there's a very small possibility. In fact, it's not a probability. It's just a small possibility that we'll see higher prices right away. But if we see a pullback in oil, we may be readying for one more move higher to complete this move before the next leg down. So we'll talk about it next week, but that's kind of the whole picture as I see it in the price of crude oil. Okay? All right, let's flip over to the bond market. Now, first, I'm going to actually start with the weekly chart in the bond market because that's what I've been talking about most of this week, or at least the last few days. So was this a reversal candle? Yes, in my book it was. So what does that mean? That means we're looking for a setup for lower prices in the price of the bond market or the price of bonds. Okay, so we're starting to see the makings of that now. And if you remember, I said what we're looking for is we're looking for some sideways movement, readying for another move lower, okay, in the bond futures contract. Now, our line in the sand is going to be up here at the high of this candle here. As long as we stay in that and we form kind of a wedge pattern, then we're going to see lower prices in the price of the bond market or the bond market itself. And that would mean higher yields. So let's look at the yield market for a second, and we'll look at the 30-year yield, okay? And as you can see, it's the opposite effect. We saw a nice healthy move up in the price of yields just when everybody was getting extremely bearish in yields saying that we were going to see new lows, we were going to see higher bond prices, and just at that point, the bond market rocketed higher, and here we are. The yields moved higher, and the bond market sold off, and here we are. Okay, this could be the makings of a bullish pattern in yields, readying for a bigger move in the yield market and a bigger move down in the bond market. So let me go back to the bonds for a second, okay? Just show you one other thing. This is for the newer members, okay? Actually, you know what I'm going to do? Let me bring up the continuous contract. This is more clear or clearer. Okay, so this is a reversal day in my book. Not to say it can't reverse back higher, but for now, this is a reversal day on the weekly chart. All right, and this is a high, okay, a lower high, and a potential another lower high. Now, if that's the case, okay, and we do start lower, I'm going to start making the case that we're going to see significantly higher yields and significantly lower bond prices from this point forward. Now, why is that important? Let's talk about that a second, okay? First of all, as I've discussed the last few days, if we do see higher yields, that means the cost of borrowing goes up for everybody. That puts a squeeze in the economy. Now, what could this mean in the terms of like a conspiracy theory? Not a conspiracy theory, but let's talk about the Fed for a second. I think even though I said to you that there's no way that the Fed is going to be able to raise interest rates in September as the market was doing what it was doing, the stock market that is, and the yield market was telling us that the Fed has no intention of raising interest rates. However, now what's happening is over the last few days, the opposite effect is happening. So, when the market tells you something's happening, even though I thought one thing, let's say a week ago, okay, but when the market tells you something else is happening, that's the world of investing and trading. You have to pivot, and you have to take the information that's in front of you, and you have to change your mind sometimes if the facts change. So let's talk about that a second, okay? Let's say the Fed decides, and this is, I think, in the second week in September is the Fed meeting, something in that neighborhood, maybe the third week, but possibly the second week. Let's talk about that for a second. Let's say the market, let's go back to the stock market a second. Let's say the stock market continues higher. Let's say we have our ABC correction, which would mean higher prices are coming, or we don't even have the ABC. Let's just say higher prices come into the Labor Day week, next week, and slightly beyond, okay? And let's say the Fed decides to bite the bullet. Let's say they say we're going to raise 25 or 50 basis points, okay? What that's going to do is possibly that's going to shock the markets, okay, even though a lot of people don't believe it, with the with tumultuous behavior in the stock market this week, a lot of the economists have pushed out their forecast to either October or December or sometime in 2016 for a raise in interest rates. So let's say the Fed surprises everybody that even though there's some folks that think that the Fed is still going to raise, and there's some that don't. Let's say the Fed bites the bullet and they say, screw it, we're going to raise interest rates. We got to get off the dime. We want to add confidence to the market, because if they delay one more time, it's basically going to tell the market that the economy is still on shaky ground, and that opens up a whole different can of worms. So let's say they raise interest rates, okay? That's probably going to be the catalyst for the stock market making the next leg lower, okay? So you see how all these things factor in. I look at so many different things. Sometimes I can confuse myself, and I don't mean to confuse you, but I just want you to understand that this isn't easy, folks. We have to be aware of all the different factors that are involved in making the decisions that I make, in how I tell you what's the likely scenario is for the market. Now, these are the ancillary factors, right? These have nothing to do with the calculations and all that stuff. When I see a market moving in a certain direction, I can tell you what the high is likely to be or the low is likely to be. What we're trying to do now is put together the detective story and the pieces to the puzzle of what the next likely scenario is going to be. And that's why I brought out all these other factors and had a lot of rhetoric tonight for you. I just want you to kind of get inside my mind and understand all the things that you need to be aware of in order to make the larger term decisions. And then once I see the market move in a certain direction or other, that's when I'm able to say, here's a price target, here's a likely stopping point, here's a likely turning point. So I'm just giving you kind of the whole kit and caboodle. I'm giving you a wheelbarrow full tonight, and I apologize for that, but I think some folks appreciate that. And I figured since it's a Friday, maybe it's a good idea just to kind of give you some of the other factors that I look at. All right, let's finish up the bond market. So here we have a weekly reversal. Okay, that's in my book. Here's the daily chart. All right, and we could see some more up move, and that would be what? That would be potentially a bearish pattern setting up for lower prices ahead. So it's up in the air. Nothing's definitive at this point, because if I look at a monthly chart, okay, I could make a case that this was a simple ABC, okay, for higher prices. That's one scenario. The second scenario is that this is a high and this is a lower high, okay? We just don't know yet, all right? There's nothing definitive that I can tell you one way or the other, but I'm just giving you all the things I'm looking at. But on a shorter term basis, I'll be able to give you some information when I see things developing, okay? If I see the market start to stall out at 159.9, which is the high of this candle here, okay, that will bring it, or I'm sorry, wrong candle. 159.9. No, I gave you the right number. If I see the market that can't get through this level here and starts to turn down, that will be further evidence that the market's going to turn down. So on a daily chart basis, I'll be able to give you more information next week on what the likely scenario is as we see this pattern unfold. But it's not unfolding yet, so it remains to be seen. I'm just giving you the bigger picture. All right, natural gas. Popped back into the channel, had a nice up day in natural gas today. So we'll see if we can get up into this high here from this candle here and the moving average. And most likely we're going to stall out up here. But there could be a few more days of higher prices in natural gas. Not out of the question. So what this did was the bearish pattern, okay, the bearish pattern underneath the underside of this trend line here, the bearish pattern may be failing. And a lot of times when you see a pattern fail, whether it's bullish or bearish, you get a pretty good move in the other direction. So we'll have to see how that plays out next week, but there's nothing that I can tell you one way or the other right now until we see this pattern further develop on natural gas. Let's just see how the next several days play out, and then we'll have more information. But on a longer term basis, look, it's still a bearish pattern, right? Sideways consolidation, and certainly on the monthly basis, this is as bearish as they come. So on a short-term basis, we can have swings in both directions, but on a longer-term basis, this is a very, very bearish pattern. All right, I skipped the dollar. Let's wrap up on the dollar. Let's go back to the daily chart. And what do we have here? No surprise, we got up into the 96.15 that I said we were most likely going to come up into. Now you're coming up into two moving averages. I don't see how we get through there right away. I would suggest that we're going to see a pullback in the price of the dollar. Now, what's possible? Okay, it's possible that this marks a longer term low. It's possible that this is an A, B, C pattern for higher prices coming in the dollar. And there's a lot of other formulas or calculations that I'm doing to determine that this could be a longer term low in the dollar. And if that's the case, okay, let me go to the weekly. Okay, you see how this may have been the final retracement, okay, of this move here, okay, because if you think about it, okay, this is a bearish pattern, right? Looking at it from just a longer term perspective, bullish. Did I say bearish? This is a bullish pattern, okay, for higher prices coming, okay? And let me show you the even longer term picture, all right? This was a breakout point, okay? This is a head and shoulders. It's a sloppy one, but it's a head and shoulders breakout point, okay? And this is nothing other than, from a very long-term perspective on a monthly chart, a bullish pattern, okay? Just no doubt in my mind, this is a bullish pattern developing. But inside of a monthly pattern like this, you can see these big swings. So you see how large of a swing this month made, okay? So this may very well mark the final low in the price of the dollar, and we could be readying for a rocket higher, okay? And if that happens, okay, we're going to see prices back up into the 100, 105, and higher in the dollar. And that one, folks, I can say is a probability, not just a possibility, okay? Very, very important, all right? So if we were to see much higher prices in the dollar, okay, that would spell a lot of other markets that would potentially have trouble. Oil, okay, oil's priced in dollars. We would see lower prices in oil. Natural gas, we would see lower prices in natural gas. Does that support the monthly picture in natural gas of a bearish nature? Yes, it does. So you can see I've got all these different pieces of these puzzles together. Okay, and it's really all the pieces of the puzzles in the various markets that I look at also comprise the pieces to make up the larger puzzle that I'm putting together for the much larger picture of what's to come over the next, let's say year or two. Okay, we don't have to worry about the next year or two right now, but what I can tell you is that just get ready for some wild behavior in a lot of these markets and a lot of volatility in a lot of these markets and a lot of different things from a political standpoint, geopolitical standpoint, global market standpoint. All these things are coming into play, and all you're seeing right now, all you saw over the last couple of weeks in the stock market, let's go right back and we'll finish with this. Let me go to the daily chart of the spider, okay? All you're seeing was this is really the beginning stages, okay, of more to come, okay? This market, in technical terms, is busted, okay? And if we just rallied back up, made new highs, and kept going, that's one thing. Then I'm just wrong, okay? That's fine. That's perfectly acceptable, and that can happen. But in the bigger scheme of things, okay, this market it made a move that's the shot across the bow, and we have to respect that. It's just a matter of how we put the pieces to the puzzle together for the next move, okay, from a shorter term perspective. But from a longer term perspective, okay, I believe that this marks the high, okay, an annual or yearly high in the market, okay? So we'll see. We'll see how it all plays out. I'll be back with you Monday to talk more about this stuff. I'll try not to confuse you with a lot of things I don't generally talk about, but I thought since it was Friday leading into the weekend and we had one heck of a week in the market, I thought I would bring to the forefront some of the other things that I look at. And if you want to learn more about cycles, I can certainly provide some more information for you. Shoot me an email, and I'll be happy to discuss that with you individually. I have no problem with that. So with that, folks, I'm going to give it a wrap tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.